In today's digital world, have you ever stopped to consider the actual form of your wealth? For most people, their entire net worth consists of numbers on a screen. Their bank account, stocks, or cryptocurrency holdings are merely digits in the digital ether. But what does this mean for the security of your finances? Those digits don't represent physical cash sitting in a vault somewhere. They exist in a system that relies on complex algorithms, third parties, and a degree of trust in institutions. If everyone were to suddenly withdraw their money from banks, the entire system would collapse because banks simply don't keep enough physical cash on hand. This isn't a fringe conspiracy theory, it's the reality of how modern banking operates under a fractional reserve system. Essentially, the bank is only required to hold a fraction of the deposits in reserve while the rest is lent out, meaning your cash is, in reality, an IO from the bank. This system works smoothly until there's a crisis, and that's when the fragility of our financial infrastructure is exposed. Now, you might argue that digital currencies like cryptocurrency offer a solution to this problem. After all, cryptocurrencies operate independently of traditional banking institutions, right? While cryptocurrencies do provide an alternative to fiat currencies, they come with their own set of risks. Let's look at recent events involving major cryptocurrency exchanges. The collapse of FTX wiped out billions of dollars overnight, while the infamous MT Gox bankruptcy left 850,000 Bitcoins missing. Even established players like Coinbase have warned that customer assets could be at risk if the company faces bankruptcy. The adage in the crypto world is not your keys, not your coins, meaning if you don't hold your cryptocurrency in a private wallet, you don't really own it. However, even hardware wallets won't protect you from the risks of a total market collapse. The fact is, whether it's a bank or a digital exchange, you're placing trust in a third party, and with that trust comes risk. This is where the conversation shifts to something timeless: physical precious metals such as gold and silver. Unlike digital or paper assets, when you hold a gold or silver coin in your hand, you possess something with intrinsic value. There's no counterparty risk, no reliance on the solvency of a bank, broker, or exchange. For over 5,000 years, gold and silver have served as stores of value, transcending economic crises, currency collapses, and geopolitical turmoil. They represent tangible wealth that exists outside of the digital sphere. Let's now address one of the biggest misconceptions surrounding precious metals: their fluctuating prices. Many people look at the rising price of gold and silver and assume these metals are becoming more valuable. In reality, what's happening is the decline of the US dollar's purchasing power. Consider this: in 1964, a gallon of gasoline cost around a quarter. That same quarter, which was made of silver, is now worth approximately $6, enough to buy about the same amount of gas today. The price of gasoline hasn't skyrocketed. Instead, the value of the dollar has plummeted. This is a clear indication of the long-term decline in fiat currency value. And it's not just a US problem. Currencies worldwide are losing their purchasing power over time. The dollar's decline is exacerbated by external factors too. Its position as the world's reserve currency is being challenged like never before. Take, for example, Saudi Arabia's consideration of accepting the Chinese yuan for oil sales, or the efforts by BRICS nations to develop alternative payment systems. When countries like Russia are cut off from SWIFT, the global financial messaging system, it forces them and other nations to seek alternatives to the dollar. Weaponizing the US dollar has unintended consequences, encouraging other countries to create financial systems that bypass the dollar altogether. History is full of cautionary tales. In Weimar Germany during the early 20th century, people who owned physical gold and silver were able to preserve their wealth, while those relying on paper money saw their savings obliterated by hyperinflation. More recent examples include Venezuela's ongoing hyperinflation crisis and Zimbabwe's currency collapse in 2008. The lesson here is clear: when fiat currencies collapse, those holding physical assets like gold and silver retain their wealth, while those relying on paper money often lose everything. To be clear, owning gold and silver isn't about getting rich quickly. It's about preserving wealth and protecting yourself from systemic risks, including the devaluation of fiat currencies. Gold and silver won't necessarily make you wealthier, but they will help ensure that your purchasing power remains intact as currencies lose value. Think of them as financial insurance, a hedge against the unknown. There's also an interesting opportunity for silver investors today. Historically, the gold to silver ratio, that is how many ounces of silver it takes to buy 1 ounce of gold, averaged around 15:1. Today, that ratio is closer to 81, suggesting that silver may be significantly undervalued compared to gold. Savvy investors could consider accumulating silver now, with the possibility of converting it to gold later if the ratio normalizes. This isn't about speculation or trying to time the market perfectly. Rather, it's about positioning yourself strategically for the future. silver also has practical advantages over gold in times of crisis. In a scenario where fiat currencies experience extreme devaluation, silver is more practical for smaller transactions. You wouldn't want to break out a 1-ounce gold coin to buy a loaf of bread or a tank of gas. Silver, on the other hand, is much better suited for everyday purchases. Another factor to consider is the rise of central bank digital currencies, CBDCs. Countries like China are already rolling out their digital yuan, and Europe is developing a digital euro. Even the US Federal Reserve is researching the possibility of creating a digital dollar. Some nations are considering backing these new digital currencies with physical assets like gold. If this happens, it could accelerate the decline of the US dollar and traditional fiat currencies. So what can you do to protect yourself in this uncertain financial landscape? The first step is to diversify. Consider converting a portion of your digital and paper wealth into physical precious metals. Silver, in particular, presents an attractive opportunity given its current undervaluation relative to gold. This strategy isn't about chasing profits, it's about ensuring you have something tangible to fall back on if the current financial system experiences significant disruption. Next, make sure you store your metals securely, whether you choose to keep them in a home safe, a private vault, or even in an international storage facility. It's crucial that you maintain control over your assets. And finally, continue educating yourself about monetary history, economics, and the evolving financial landscape. Throughout history, every fiat currency has eventually returned to its intrinsic value zero. Physical gold and silver are among the few assets that have withstood the test of time, surviving every financial crisis, war, and currency collapse the world has thrown at them. While you don't need to put everything into precious metals, having no exposure to them in today's volatile environment could be the biggest risk of all. So what's your take on precious metals in the digital age? Do you see them as essential financial protection, or do you think the modern financial system is strong enough to weather any storm? Let me know your thoughts in the comments below. And if you found this information valuable, don't forget to like, subscribe, and hit the notification bell so you don't miss out on more insights into how to safeguard your financial future. Thanks for watching, and I'll see you in the next video.